We're going to be doing a height measurement of Chris Kirkpatrick. Yes, he's shorter than he looks. You.
This guy's a
Dude.
giant.
How do you feel
This
about
guy,
that?
you're an
Guys,
oaf.
let's record some content.
Hey, nice neck, dude.
Somebody literally said that to him the other day.
I'm joking. I
How
didn't mean that.
I thought you would be.
No way. I didn't mean that.
Hey, what's going on, everyone? Welcome back to my channel, and thank you so much for clicking on this video. So today we're going to be going over common misconceptions around whole life insurance and infinite banking with 4 other individuals, and I'm going to break this video down into 4 segments because it was a 40-minute video, and I like to keep my videos around 10 minutes. But as you guys can see, we're in the Dominican Republic at the Life 180 Mastermind Retreat. It's been such a blast, and I'm going to leave everyone's links in the description that was in this video. I love networking with these guys, and they are a wealth of knowledge. Each person's an expert in their own field. Really appreciate it if you guys can like, comment, and subscribe. Keep my channel growing and people getting served and helped the right way in the whole life insurance industry, in the financial service industry, because there's too many people doing the wrong thing, and we're gonna discuss that in this video. So like I said before, thank you so much for joining me on this amazing journey, and I look forward to seeing you in the next video. With that said, let's get on with this video.
Something I like to explain to clients, and I don't know if you guys will align with this, but like infinite banking is a concept at the end of the day. It's just a concept. So people are like, Matt, could you do infinite banking with an IUL? Can you do, infinite banking could be known like going and borrowing money, equity at your home equity line of credit, go put it on a new property. Now you have cash flow from that new property, blah, blah, blah. The reason why we use whole life is because it's the best vehicle. It's just the right tool for the job. There's nothing like it.
It's not just because of guarantees, but because of the fact that it's backed up by the death benefit, and that creates a security that self-completes what the actual objective of your investments are.
So Jeff Kamke here with Wealth Energetics. So I think for me, the biggest misnomer is the fact that, and you hear this from the pundits out there, the so-called experts that talk about the bad things with whole life, is that, well, you're borrowing your own money, which is not true. You are not borrowing your own money. Who in their right mind would ever sign up for something like that? That's almost worse than an IUL, convincing somebody to do that, right? So what are we actually doing? Well, we're using the cash value inside the whole life policy as collateral. The life insurance company says, oh, you've got this cash value, I'll give you a loan against that. It's no different than the HELOC example. You have a home, it has value, the bank's willing to leverage that value and give you a loan against it. It's the same scenario. So no, we're not paying interest on or we're not borrowing our own money. We're borrowing the life insurance company money. So why in the world would we want to do that? Because Dave and a lot of these other people say, well, that's a stupid idea. Who wants to go into debt with their own money? So, okay, let's break this down. Well, why would you want to do that? Well, if you have cash value contractually obligated to grow every single year, plus dividend growth on top of that, we know that there's never going to be interruption in that growth, right? So we have an ever appreciating asset over here. So that means the banking function is always growing. So we can borrow against that, which doesn't interrupt the cash flow, the growth of that, which is a wealth principle. The middle class is taught to liquidate an asset, take the tax hit to get access to cash. That's a middle class money mindset versus the wealthy know, if I put money into an appreciating asset, and there's other appreciating assets other than whole life insurance, it can be real estate, it could be your business, it could be other things. And to be able to leverage that, you're not liquidating it. There's a no taxable event when you take a loan. So when you take a loan, yes, there's an interest cost to that loan, but you're gaining interest over here. And this goes back to the whole positive arbitrage thing. Depending on the interest rate environment that we're in, sometimes it can be positive arbitrage, sometimes it's not. It might be a break even, but we're not looking at it with blinders on, like focused on, well, this is this percentage rate and this is this percentage rate. We're looking at the whole picture. We're looking at all moving pieces and what's the most efficient process to do with our money. And we're going to come out ahead, because after you get several years into a policy, that compounding growth is going to exceed what we're paying in an interest cost, because we're talking simple interest on a policy loan and we're talking compounding interest over here. And you can run those calculations, and the further you get into it, the better it is for your financial situation. So we want to be taking policy loans so that we can go do other things with that money and not interrupt the growth of the cash value inside of our policy, because then we're making money in two places. And the second place might be real estate, it might be investments, it might be our own business. Either way, we're better off because we're taking policy loans. So it's,
And we'd want to do that.
Especially when people like Dave Ramsey, you mentioned, say that it's stupid to borrow your own money as a scam. Why would you do that? He's just, he's an interesting character. Would I never hear anybody complain about it? Maybe Dave does. I don't know. You watch more of his content than I do. Nobody ever has an issue with paying interest to do a home equity line of credit.
Yeah,
good point.
I never hear anybody say anything bad about that, yet
Good point.
everybody does it.
Yeah.
Why is it any different with a whole life insurance policy? Because the cash value in the policy is literally the same exact thing as the... Wow, that was good. As the equity in your home. Yeah, that was a good addition there. We're getting some background music there. Some live sound effects.
Yeah.
But the cash value in your policy is literally the same thing as the equity in your home.
Yeah.
So why is it a problem with whole life insurance? And last thing I'll say on it is it's absolutely worth it to pay a little bit of simple interest to build wealth like you normally would and get that uninterrupted compound growth. Guys, I've run the numbers on this. It's insane.
Yeah.
Like I ran this scenario when I used my policy to purchase my vehicle to eliminate lost opportunity costs.
Mm-hmm.
My loan rate is 5.5% right now. I ran the numbers. I could have had an 8% loan rate, only earn 4% in my policy, and in 5 years, my policy has made more than what I paid into the loan because my policy is getting compound growth, and I'm paying down the simple interest on the policy loan. It's getting on a smaller and smaller balance with the policy loan. It's a higher and higher balance with the policy growth. Yeah. So even you could have a higher rate, a higher loan rate than what your compound rate is, and still come out ahead. Right. That is why it is worth paying a little bit of simple interest to get the uninterrupted compound growth.
Right.
Amen.
I kind of want to drop the mic, but that's too expensive. But we'll just use a policy loan to buy a new one. So
dropping coconuts.
I know. Dropping coconuts over here.
I think for me, one of the biggest things is this is not an investment whatsoever. There's too many people who are like, "Oh, I'm going to invest in whole life insurance," and then I stop them right there. Yep. And I'm surprised none of you guys mentioned that, right? Because like that's a big component. A lot of
first. Give me a break. 11 o'clock at night. We can't think.
Yeah. Right. Yeah. Yeah, after all the meditation, I can really think, guys. I can go all night now. But no, yeah, it's not an investment. Our wealth has to reside somewhere, and we're already going to be saving money. And this is not the end-all, be-all strategy. And, like, I don't like to pitch it like that anymore. Yeah. I used to because I was so passionate about it, and it was working for me, and I had one. But I was only 12 at the time, okay, guys?
12 at the time.
When I got in the industry, I was 12 years old. I'm industry plant. Chris has raised me from a young age, so so it's not an investment, and we like to use it as a savings account on steroids, is what I like to say. Savings alternative on steroids. Sure. All right, because our money has to reside somewhere, and you're going to either save it in. And here's the thing: you're not going to dump all your savings into this. This is a diversification tool. But this allows you to have something that rides alongside your life, gives you protection, gives you a rainy day fund, or gives you an emergency fund, and all these things in one. Opportunity fund. And I think you use that word a lot, right?
Listen, I look at it this way. It's like too many people look at the world and they think, they need to keep up with the Joneses, and there's this whole FOMO thing going on. Like the market does well, we feel like we have to compete with them, and it's that like water cooler syndrome. Everybody's talking, I'm making 15%, I'm doing 12%, I'm doing this, and like so having your money in a whole life policy being like, I got 4.5%, like that's
everyone's like,
it's kind of like nobody wants that. But the bottom line is, the problem is financial structure. The problem is the fact that, okay, it's great that people are getting 15% and 12% and 20% and then whatever they're getting, but that's during the times when we've been in the greatest bull run of all time. And if they don't have enough saved money, if they don't have enough liquid accessible capital, and if they're not prepared when the stock market goes the other direction, because the market is cyclical, it goes up, and we've been. I mean, if you look around right now, all you have to do is look around right now. and look at the PE ratios of all the stocks. They're at the highest ratios they've been since 1929. In case you didn't know, something pretty significant happened in 1929, right? Like when you look at the PE ratios the way they are, when you look at the unaffordability ratings of housing in this country, with interest rates, with national debt, with inflation, with all these things, every indicator across the world, across the board in the financial economy is like, it's not going to be good. And so people have ridden that up and they feel really good. But guess what? When your money's in your 401k, when your money's in your IRA, is it really real? Yeah. You don't have it. Everybody's like, oh, I'm going to put my money in a whole life policy and I only get 90% access to it. Well, what do you got access in your 401k?
Yep.
Nothing. Dude. Really, you know? Yeah. And not only do you have nothing, you can't touch it till you're 59 and a half. And by the way, it's in these high risk assets that when the market goes down, your 15, 20, whatever percent gains annually, now you lose 50% of it in 1 year like everybody did in 2008. Yeah. Yep. And now what? What's your returns? I will take the slow and steady 4.5%, build my opportunity fund, and when the market goes through into the tank and real opportunity is created, I'll be sitting on capital when everybody else is crying, and I'll wait and I'll take advantage of the opportunity then. And the cool part is, and I learned from, I didn't get to do this in 2008, right? I've been eagerly waiting for this moment for 15 years, right? Like because of the fact that like I talk to people, my mentor Mike Wolf, who does a lot of real estate stuff, right? Like I mean he's mentored people on hundreds and hundreds of single family homes and whatever. And in 2008 he said while everybody else is freaking out, that's when he got rich. Right. Yep. Because he was sitting on capital and waiting, and houses in Las Vegas, when they went down 60 and 70%, he was able to buy over 200 of them cash. Right? Yeah. And guess what? From 2009 to 2015, they went up 300%. So you tell me, what do you want? Do you want to get the follow the plan that, you know, puts you in a position where maybe you can get 10 to 15% and lose 30, 40, 50% of it overnight, potentially after a decade, and then realize you lost a decade of potential? Or do you want, that's my phone. Yeah, it's my phone. It's fine. But, or do you want that? Or do you want to, you know, lock in 4.5%, 5% over a long term? Make sure you have your emergency fund taken care of. Your financial foundation is completely built and solid. And now you have an opportunity fund. So when that happens, you're able to buy an investment, an actual investment outside of the policy by leveraging a policy loan and getting 200 to 300% in a 4 or 5 year period. Amen. I'll take that every single time.
Yeah, 100%. There you go.